Hello, everybody. This is Professor Hassey. It's week 5, our lecture video for the week of September 20th to 26th. Today is Tuesday, September 21st, and our topic this week is capital budgeting risk analysis, talking about 2 keys to guaranteeing a safe, or not a safe, but a reliable capital return analysis is doing sensitivity and scenario risk analysis, a key part of the electrics case, which we're going to review today. I also will be having a special review video this weekend on Saturday to be exclusively on the electrics case, because by Saturday, hopefully you'll have case number 2 wrapped up and you can start concentrating on the electrics case. I'll be having a video to be posted Saturday, September 25th, which will be dealing exclusively with areas of the electrics case to be reviewed by your team. And so look for that this coming Saturday. Our subject this week is capital budgeting risk analysis. And let me show you a couple of things in Blackboard that I have set up this week that could be of some help to you all. Here's our Blackboard site, and as we begin our 5th week of study, we're at the halfway point of our class. Make sure all of you, as you complete case 2, and I post the grades for case 2 this next week, make sure you take a look at your grade center. Make sure you understand your grade at this point of class heading into the final half of our course. Make sure you understand your grade situation, and if you have any questions on that, be sure to let me know. If we go to the week 5, our week 5 file folder, there's my introduction video. And here is some important dates. I've had some questions from some students. Mr. Hassey, what's our schedule? What are the due dates? And what do we have left in this course? And so I thought I'd throw this into week number 5. Case number 2, which is 20% of your grade, due September 26th, Sunday. Case number 3, which is a risk analysis on a case study, which is due Sunday, October 3rd, 20% of your grade. And in case number 4, which is a analysis of alternative forms of capital financing, which will be a PowerPoint analysis, is due Sunday, October 17th, our last Sunday of the course. Also on that last Sunday of our course is our group case paper. Remember, each team is to submit 2 files, a paper file in a Word or PDF format, and then a spreadsheet file with all your various capital budget analysis. Course evaluations are due on Tuesday, October 19th. And I will, once you complete your evaluation, and I'll talk more about that as we go along, final grades will be posted to Blackboard on Thursday, October 21st. So that's our timeline for the next few weeks of our course, so everybody is familiar with that. There are extensions available for case 2, 3, and 4, but there's no extensions available. There's extensions available for case 2 and 3. There's no extensions available for case 4 and the group case paper. Those are the very last day of our class. I have to have the grades due in the next week. So there's no extensions for case 4 and the group paper. So just make sure everybody understands that. Also in week number 5, here is the spreadsheet file that we began last week in week 4 of a capital budget analysis. We're going to update that and talk about risk analysis in today's class. Underneath that is a checklist of key things you need to tick off in their order in order to complete this electrics case by your team. This will be the subject of my electrics case video on this Saturday. I'll be going through all these points and making sure everybody knows where they are, what they mean, how they locate them, and we'll be reviewing this in my video on Saturday. That gives us time to complete case 2, understand the capital budget analysis, and then we get into the electrics version of that, and this is a checklist we will be doing. All right. And again, if any of you have not done so, make sure you meet with your group. I know a lot of groups have been set up already and meetings have been available, and you've been beginning working on that to understand the parameters of your team and make sure everybody understands that. If anybody's having any concerns about that, just please let me know as soon as possible so we can make sure we're all on the same page with this project. Okay, I now have that spreadsheet file up for week number 5, which is basically an extension of the week 4 template, and you can use either both. I put both in each week. This explains the capital budgeting process in a couple of steps. Remember, the capital budgeting process is a way of determining an investment in an asset. Is it returning and giving you an adequate enough of profit of return? And a way of calculating that profit and return is the net cash flow, which is a combination of net income, revenues minus expenses, taxes, and then a combination of depreciation, working capital, and salvage value to determine the net project cash flow. Your return analysis is net present value, internal rate of return, profitability index, and payback. We're practicing these in case number 2. And then the subject of our class this week, our lecture this week, is okay, now we've got the base case, our basic analysis done, and it looks positive, it looks pretty good. What are the risks associated with scenario? What are different output levels of output? How many units you're selling? What if that changes? How does that affect the bottom line? Another is the sensitivity analysis, which takes a look at key variables of your case. Selling price per unit is usually one. Variable cost per unit is usually one. Maybe weighted average cost of capital is one. Tax rate is one. All different variables and how sensitive for changes in those variables to affect the profitability of your project. Important things to know if you're managing and doing a critical thinking analysis of a potential investment. So that's what we're doing this week. So remember, last week we went over the determination of the cost of capital. To determine a cost of capital, you need 2 things. You need the capital structure of a company. What percent is debt financing your asset and what percent is equity financing your asset? All right. The second thing you know is the parameters of the specific funding. What is your interest rate on your debt? What is the tax rate on your debt? What is the risk-free interest rate? What is the market rate of return? What is the firm's beta? These are all the risk in the market for equity investments. Zero risk is the risk-free rate. Average risk, or a beta of 1, is the market rate of return. And your specific individual company's beta. Put these all together through the capital asset pricing model, and you determine the cost of equity, or the expected return that investors would demand of your firm at this present time based on the risk of your company and alternative risk in the market. Then you weight those interest rates by the capital structure of the company, 60% debt, 40% equity as in this case, and we get our cost of capital, 8.1%. That's called the hurdle rate. That's called the WACC rate. That's called opportunity costs. That's called cost of capital. It's been called many things, and sometimes in bad language, I might add. But that cost is what it's costing the company today based on their capital structure and the relationship of the company in the market, both for credit and equity, what it's costing for their money today. And we use that as the discount rate in our analysis, our capital budget analysis. This is taken out of chapter 10 and 11. And remember last week, we put together a spreadsheet to determine the net cash flow of a project that's an investment of $1 million. Remember, year 0 is today. What is this going to be returning to us in sales, expenses, taxes into the future? And the future in this case is 10 years. That's our depreciable life of this asset. That determines the life of this asset, financially speaking. Financial analysis says the life of an asset is its depreciable life. So in this case, it's 10 years, and it's a $1 million investment today. We're going to take that $1 million investment today and compare it to the future cash flows being generated off this investment that we're proposing. And then we're going to discount those future cash flows back to today, year 0, at our cost of capital that we just determined as 8.1%. And we went over this last week. This is what case number 2 is all about. I've had some questions from some students this week is, Mr. Hasse, how do I set this up? Well, you set this up just like this. This is a capital budget analysis. This is what you do. And you have to adapt this template to case number 2. Case number 2 does not have 10-year depreciable life. What is it? Case number 2 does not have these specific variables. They have variables, but they're different numbers. So your job as an MBA student is to adapt the case number 2 numbers to the format that tells us what is the net project capital for case number 2. Thus, you can determine the net present value, the internal rate of return, and so on. So that's your job in case number 2, is to adapt that and practice it. Case number 3, you'll do a risk analysis of a different case. And we'll talk about that in just a minute. But that's the subject at hand. This is what I'm expecting for case number 2 this week. A spreadsheet very similar to this, set up in the parameters of the case that it gives you. Your job is to calculate the cost of capital. There's a template for that. Your job is to calculate the net project cash flow. And your job is to take that net project cash flow and discount it at whatever cost of capital you determine, and then determine these returns on investments. If you want a reference guides to the chapter, it's page 412 to 430 in your text that talks about that. But this is the setup that you're going to be using in the electrics case, you're going to be using in this case. So this should help you. Your job is to adapt to it. And that's what this study is all about. So once you complete that, and we completed this last week, we found that this case or this project of $1 million investment is going to be pretty decent. It's going to return us about $500,000 in net present value. It's going to return to us about 17% of return. Its profitability index is way over 1. The ratio is 1.48. And it's going to pay us back in less than half the time of the project in about 4.94 years. That's how long our payback is. So it's a pretty good investment. But now let's do another step in this analysis. Are these numbers, or what if situations change? What if the environment of this $1 million investment changes due to the economy, due to a labor contract, due to a supply chain management problem? Welcome to the pandemic. And companies for the last year and a half have been adapting these strategies and these disciplines as the economy and their market conditions have changed. So we need to know this, and we need to know how to adapt to it. All right. The scenario analysis is listed right here. I'm sorry if you can't see that very well. The risk analysis is made up of what if our sales are not 25,000 units, but 12,500 units? What if our strong sales are 35,000 units instead of 25,000 units? What happens if our volume changes in this project? Are we going to make money or lose money? Now, this is in the context, and this is where this gets a little confusing, is what is the probability? What is the likelihood of 12,500 units sold over this project instead of 25,000 units? What is the likelihood that our projections of 25,000 units are actually going to take place? And what is the likelihood that we might, in fact, have strong sales of 35,000 units? What's the probability of that? Now, in the real world, you have internal auditors, you have statisticians, you have probability experts with companies or with your public accounting firm or consulting firms that calculate these risks and probabilities in your business. And in our class, I just give you the probabilities. There's a 25% chance that we're going to have 12,500 units sold instead of 25,000. There's a 50% chance that your original projection of 25,000 units is going to happen. And there's a 25% chance that our sales are going to be $35,000. So if we take those probabilities and those likelihood, let's fit those units into our template here and see what happens. So I've created another tab here called Risk Analysis. And here's our scenario analysis up here in the upper part of the spreadsheet. What's the likelihood that we're going to sell 25,000 units at a 50% probability? Well, we already did that in our base analysis, 25,000 units. And the net present value of that is $504,799. So I put 504,799. So if I weight that NPV by the likelihood of 504,799 by the probability of 50%, I get 252.4. Okay. Sorry about that. It's the White House calling me, but they can wait. So, and now I go back to my scenario analysis. Remember, we saying our strong analysis says 35,000 units could happen with a probability of 25%. So I just go back to my base analysis, and here I put in, instead of 25,000 units, I put in 35,000 units. And because I have my templates already set up with my formulas, that just a simple change of that cell will change the appropriate cells. I type in 35,000 and boom, all my sales change, my variable cost change, my working capital changes. Everything changes in relationship to that increase in output. That's why putting together these spreadsheets can be very beneficial if you do it the right way. You just have to change a couple numbers and you could adapt to different scenarios. So by putting 35,000 units here, I now have a net present value of 1,117,358. So let's put that in our table, 1,117,358. And that's a 25% likelihood of that happening. So there's my weighted amount. Now let's see what our net present value would be if we have a deduction of an output of only 12,500 units during the life of this project. Put 12,005 there, and boom. Notice at 12,005, we're losing money, negative at present value, a very low return rate, a very low profitability index. Notice payback doesn't change because that's a different formula. So 260, 899 loss. So let's put that into our table. 260, 899 negative. And that's weighted by 25%, and we get 65,225. So what did we just do? We went back to our base analysis and just changed one number. And let me highlight that number here. We just changed one number, units sold. And that unit sold is part of a scenario analysis, which changes the output based on certain scenarios. Probability, maybe the economy changes and we can only sell so much. What happens if all of a sudden we have a 50% reduction in our output from 25,000 to 12,500? Well, we start losing money and we should be aware of that. So that's what's driving this scenario analysis. So now I change it back to where it was at our original case. And now what we've done here is we've created a little table which shows the NPV at these various output levels and weights them by the likelihood or probability they happen, and we get a weighted net present value. And as in the case of this analysis with it 50, 25, 25, which is pretty straightforward, our NPV on average with weighted is slightly lower than our original NPV of our 25,000. But if these probabilities are different, that can, if you have a higher probability of weak sales, that could influence the weighted NPV of your case. And so the correct answer is under the scenario analysis, at these probabilities, at these different likelihood of outputs being sold by this project, our weighted NPV is 466,514. So that works out pretty good. Now, the risk analysis for sensitivity is an entirely different analysis. It's using our base case of 25,000 units. But then, as you can see here on this page, it shows three variables that make up the sensitivity analysis: sales price per unit, variable cost per unit, and weighted average cost of capital. And if those change by plus or minus 5, 10, or 15%, how does that affect the net present value of this project? But you only change one variable at a time. That's why it's called sensitivity. What is our NPV if just our sales price changes, plus or minus 5, 10, 15? What is our NPV if the variable cost per unit just changes, plus or minus 5, 10, 15? And what is the net present value if our WACC only changes plus or minus 5, 10, or 15? That's the sensitivity analysis. So here, as you can see, I've created a chart, and that chart has a corresponding graph where I'm going to plot the changes in net present value based on changes in selling price, changes in variable cost, changes in weighted average cost of capital. So our original selling price in this case, the base case, is $20 a unit. Our original variable cost per rate is $8 a unit, and our original WACC is 8.1%. So now we're going to alter these three variables plus or minus 15, 10, 5, 15, 5, 10, 15, and find the corresponding NPV for those numbers. And then it's going to you're going to develop a range of negativity to positive and how that affects the profitability of your project if you change those variables. And the key thing for this is if you guys ever have heard in your companies or your businesses, if you ever heard of SAP software or Oracle software, or let's see, those are the two biggest ones, Oracle and SAP. These are companies, software making companies. One, SAP, is located in Europe. Oracle is located in San Jose. It's run by a fellow named Larry Ellison. And these companies allow you as a company to download accounting data and apply applications to create these analysis, scenario and sensitivity. Many companies invest huge amounts of money into their accounting packages, and then they buy these applications from Oracle and SAP. And these applications convert this data into sensitivity analysis and other types of analysis to use your data into strategic thinking, critical thinking about your company. It's huge. It's a big business. So what I'm going to do is I'm going to go through the process of going back to my base case and changing each variable one at a time. Selling price, variable cost, and WACC. And how does that affect net present value? And I'm going to chart it. So let's begin. Let's first of all start with the variable selling price. What is our NPV going to be if we take a 15% reduction in our selling price per unit of $20? Let's say we can only sell 25,000 units in this project if we sell them for 15% less. If we sell them for 15% less, we're going to be able to sell all the 25,000 units. But if we do that, sell them for 15% less, how is that going to affect our profitability? I would think it's going to affect it quite a bit. So let's go to our base case and go to selling price per unit. Okay, and let's take that $20 and multiply it times 0.85. What's 0.85? 100% minus 15 is 85%. So we're reducing the selling price by 15% by multiplying it times 0.85. And naturally, as you know already, I've set up my template to adapt to that. So if I put $20 times 0.85, it changed my revenue line and it changed my working capital line. Thus, my net income changes, my project cash flow changes, and look at my NPV. At a 15% reduction in my selling price with all the other variables staying the same, I'm making a profit, but only 123,418. So I put that right here, 123,418. Now let's do it for a 10% reduction. Go back to our base case and now alter that by $20 times 0.9. A 10% reduction in sales price, $250,545 net present value. $250,545. You might want to try this on your own and see if you can do this with this spreadsheet. Notice a line begins to be creating here. This chart is corresponding with this graph, or this chart here is corresponding with the graph, and you can see a line starts taking place. Now, what's a 5% reduction in our selling price? $20 times 0.95. We're making a little bit more, 377, 672. And you know you're doing this correctly when this line is straight. You know you're doing this information correctly when there's no blimps in this line. It's not going up and down. It's staying straight. That means you're holding true to your analysis of the specific changes in percentages. So let's go back to our base case again. And now let's make this now with no change in selling price, the original case. And that ends up being the 504,799. So let's put that here with no changes. Okay. And now a 5% increase in the selling price. What's going to happen to our net present value? Again, remember, I'm not changing any other variables, only the selling price per unit. So I go back to my selling price times 5% increase is 1.05. 100% plus 5% increase, that's 1.05 in a decimal, $20 times 1.05. And I'm making $631,926. 631,926. So I'm beginning to fill this out, and notice my chart, my graph is staying straight. No other variables are changing but selling price. A 10% increase in my selling price, $20 times 1.1. 759,054. Again, this is so easy when we're doing it this way because we've set up our template. We got the formulas what they should be. We just change one number and we can get new information provided off this. So 759,054. And there we go. And lastly, a 15% in our selling price times 1.15. It's 886,181. So let's say I put in 876,181. I did a keystroke error. Look what happens to my line. It changes a little bit. You can't see it very well. Let's make it a little bit more direct. Let's make it 806,181. See how that line changes? Hey, that's not straight. What did I do wrong? Something went wrong. So I go back to my number and I said, oh, it should be 886,181. 886,181. And there my line straightens out. Pretty sexy, isn't it? That's a joke. All right, so there's my straight line. There's my line of selling price per unit from a 15% reduction to a 15% increase in my selling price. And notice it's a straight line because our percentages are within 5% increments. And the range from top to bottom is about $762,763. From negative 15 to positive 15, there's the range. That range determines the steepness of my slope of my line. Okay, so now let's go back to the base case. Make sure our selling price goes back to $20. So everything is back to normal. And now let's do variable cost and changes to variable costs by these percentages. And how does that affect NPV? So a 15% reduction in variable costs equals $8 per unit times 0.85. We're lowering our variable cost rate by 15%. Now we should be making more money, right? Because our costs are going to be lower. And there they are. Our variable cost changes, that influences our net income, that influences our project cash flow. And now we're making 656,471. 656,471. And we'll go through now and change 10% to our variable cost. $8 times 0.9. 605,914. And there's another line that starts creating. Remember, this is an expense, so the line is going the opposite way. Revenue expense. 5% reduction in variable costs times 0.95, 555, 357. There's no changes, so that's still 504, 799. And then a 5% increase in variable costs. Let's say we have our wages go up, or we have a new labor contract, or our material costs go up, or whatever. Now we have $8 times 1.05, a 5% increase in our variable costs. We're starting to lose money, 454, 242. A 10% reduction in our variable costs. No other variables change, just variable costs, 1.10, 403, 685. And then finally, a 15% reduction in our increase in our variable costs, 1.15, 353, 127. And we're done. Hey, that line's straight too. And you know you're doing this right because where the two lines intersect is our base case 0% change analysis, 504, 79, 799. So you're doing this right because they intersect at my base case analysis amount. But notice back here, our range is a lot lower than variable costs. With selling price, we had a 762, 763 variance from one number from top to bottom. Here it's 303, 344, a lot less. And notice the slope of the line is not as dramatic as the selling price. Another good point to make. So now let's go back to our base case and put variable costs back to where it should be, our original analysis. We're back to 504, 799. And now let's change WACC. Now, where does WACC fit in all this? Well, WACC is our discount rate down here to determine discounted cash flow. What if this interest rate, our money becomes more expensive or cheaper? How does that affect our NPV? Because it's going to alter the discount of our project cash flow. All right. So let's now go to our risk analysis. And we have a 15% reduction of 8.1% our WACC. So let's go to here, change 8.1% and multiply that times 0.85, 15% reduction. We get 6.89%, a 15% reduction in our cost of capital. So go down to the discounted cash flow line to our formula right here. See, it says 8.1 there, and put in now 6.89% to match that 15% reduction. And we get a change in discounted cash flow. Thus, our NPV goes to 608.55. Cheaper money, more profit. 608.55. Put that in our chart. WACC, again, 10% reduction. So we go back to our WACC line. Notice I'm not changing any other variables. Times 0.9%, 10% reduction. That's 7.29. Put that down in our formula here. 7.29. Money is a little bit more expensive. We make less NPV, 568, 147. And now our line will start showing up again there. A 5% reduction in our cost of capital. 8.1% times 0.95, 7.7%. Put that into our formula for discounted cash flow. 535, 611. Notice no other figures change up here. The cash flow is always the same because we're not messing with that. We're changing the cost of money. 535, 611. There we go. Again, 504, 799 stays the same. That's a zero change in WACC. And notice they're meeting again, all at the same place. Now a 5% increase in our WACC. 8.1 will now be increased by 1.05. So the rate goes to 8.51%. Put that into our formula, 8.51. Naturally, money is now more expensive. We should make less money. And we do. 474, 138. 474, 138. 10% increase in cost of money times 1.1, 8.91. 8.91 in our discounted cash flow formula, 445,090. People do this for a living. And then finally, 15% increase in our cost of money, 9.32. Ouch. $416,171. But notice the changes in profitability are fairly minimal because of WACC. Is that the interest rate has somewhat of an influence on profitability, but not as much as variable cost and selling price, naturally. 416,171. And there's our line completed. And notice the variance or range of the WACC from top to bottom is only 184,684, a lot smaller even than variable cost deltas. And that's why the line is even flatter, less of a slope. And we're done. Now, in the real world, this is done for every variable under a lot of different circumstances. But to keep it fairly simple in our analysis, we're just dealing with 3 variables. Your job in case number 3 is to do this for a case that I give you, where I already give you the capital budget analysis, and you have to change and do a risk analysis. I will provide you all that information, and we'll take that from there. But in this case here, and also you have to do this in the electrics case, and I will talk more about that on Saturday's video. In the electrics case, it's a little bit more challenging for you. Matter of fact, quite a bit more challenging, but by then you'll be experts after 2 cases of working on this, and you should be able to figure that out. We'll talk more about that this weekend. So what does this, here's the big question, what the hell does this tell us? Let's write that down. What the hell does this tell us as managers? Well, it tells us a few things. It tells us that a change in output is going to have a fairly minimal effect based on the probability calculations that those will occur on our overall profitability. We can have a 50% increase and a 50% reduction in output, and we're still making pretty good money NPV. So output's not a big driver as far as risk in this case, based on the probability concerns and those numbers. In this particular case, output changes are not that big of a deal. What is a big deal is in the sensitivity analysis. If we reduce our selling price by 15% in order to sell 25,000 units, we're only going to make $123,418 in net present value, and that's not that great. That's a concern. So many times in a pandemic or in a tight market, companies have to lower their selling price. And when they do that, they know they're going to start not making as much money or even lose money. Fortunately, in this case, none of these changes in variables are giving us negative return. But there's especially 15% increase or deduction in sales, a 15% increase in cost, and a 15% increase in cost of capital significantly reduce our probabilities from our base case. So that tells us as managers, if we go ahead with this project based on our base case of making $500,000 NPV, that we should be aware of if we cannot meet those 25,000 unit sales figures every year, and we have to lower our price, that our profits are going to be severely challenged, and we have to be aware of that. And we can see this before it actually happens. and we can be ready when it happens. Let's say into year 2 or 3, we have the new labor contract and our costs increase, and we have a 15% increase in our labor costs and our material costs, whatever. That's going to cut into our profitability. If everything else stays the same, we're still going to make money, but we have to be aware of that reduction in our profits. And what happens during the course of the future that our cost of money goes up? What happens if we have to refinance or find different alternative sources of capital to fund this business over time? Those capital costs do influence profitability, but not as much in our analysis. This is why MBA students get paid the big bucks when they graduate and put together and run companies. Their job is to understand and interpret, what if something changes? What if our economy changes? What if our consumer base changes? What if our costs change? How will that affect our profitability? Here's an analysis that you can do to act as a budget or a management tool to make sure when these changes do occur, you can adapt and be ready for them. And that's what we're doing in case number 3, and that's what we're doing in the electrics case. Case number 2 this week, the task at hand, is to just do this base case that we began the discussion last week. This is what you need to do this week. Next week, you'll do this. And explain to me why. I'm going to save this and repost it to week number 5 so you have that to download. And let's take a look at case number 2 one more time. Here's the case where you are to put together a capital budget analysis, just like we talked about, where the first part is to determine its cost of capital, determine the after-tax cost of debt, determine the required rate of return on equity under these market conditions that I give you. Read the problem carefully. Note in the case I give you market premium. Note that, please. Can't believe I'm telling you this. Note the capital structure of the company, which will weight these costs into your WACC final number. And then once you have that WACC, then you can put together a spreadsheet for 7 years with an investment of $700,000, with a depreciation of $100,000 for 7 years, a salvage value at the end of the life of $55,000, a working capital base of 8% of revenue, inflation rate of 2, 1.5, and 1.5 for these key variables, a tax rate of 20%, your units sold per year, your selling price, your fixed cost, and your manufacturing or variable costs. And you put that in the spreadsheet, and that's all you're submitting to me this week. Do the analysis on that spreadsheet and post it. The only thing you have to do in writing is tell me yes or no, would you recommend this capital investment of $700,000 under these costs? Cost of money, capital, and cost of production and expenses. That's case number 2. And you follow that format that we discussed last week and saw it again today. You don't have to do any risk analysis. You just have to calculate these 4 calculations: NPV, IRR, profitability, and payback based on this data. That's your job this week, due Sunday the 26th. So if you just keep that template and adapt it to this situation, remember, adapt it to this situation. I don't want to see any remnants of the case template that I give you in your template. You should wipe out 3 years, 8, 9, and 10. I should only see 7 years. You should wipe out all and adjust the equations for this data. That's what I'm looking for. You adapting this information to that spreadsheet. That's the key. And then we'll do a little bit more critical thinking and strategy in case number 3. So thanks, everybody. That concludes our lecture video for week number 5, and also concludes our study of capital budgeting. Next week, we'll talk about financial statement analysis and forecasting capital requirements. that'll lead us into a whole nother area of strategic thinking in corporate finance. I'm available this week for any questions or concerns. I had some students come on last night on Monday night, and I'll be available throughout the week if you have any questions. There are extensions available for this case number 2. I will look forward to your postings and your work, and I'll see you all this Saturday, this weekend, in a posted video to explain in more detail the electrics case. Thanks, everybody. Have a great week. We'll talk to you soon. Adios.